All right, let's dive right in. Today, we're tackling one of the biggest, most divisive economic stories of the year, a brand new wave of tariffs. So, are they a genius move to bring back American industry? Or are they a reckless gamble that's about to push the US into a recession? The debate is absolutely raging, the stakes couldn't be higher, and we're going to break it all down for you.
And that's really the big question, isn't it? From Wall Street traders to small business owners, everyone wants to know, are we looking at economic renewal or a painful, tariff-induced recession? Let's dig into the evidence for both sides.
Here's how we're going to break it all down. First, we'll look at what these new policies actually are. Then we'll dive into the case for a recession, followed by the case against it. After that, we'll zoom out and see how this is completely reshaping global trade. And finally, we'll try to pull it all together. Sound good? Let's get started.
So, first up, what are we even talking about here? To really understand the debate, we've got to know the specifics of these new tariffs.
You know, things moved at lightning speed back in April of 2025. On the 2nd, the administration announced this new reciprocal tariffs idea. Just one day later, bam, a 25% tariff hits all automobiles. By the 5th, a massive 10% minimum duty on all imports was active. And then, just a few days after that, even higher rates started targeting dozens of specific countries. It was a really fast escalation.
And this right here, this 10%, that's the real game changer. It's not a targeted shot at one industry. It's a baseline tariff that applies to basically everything coming into the country. This is a fundamental shift in American trade policy, and it affects pretty much every single good that crosses the border. And that leads us to, well, a massive number. The highly respected Penn-Wharton budget model ran the numbers and projected these tariffs could bring in a staggering $5.2 trillion in revenue over the next 10 years. Now, keep that number in your head, because it's at the very heart of the arguments on both sides of this debate.
Okay, so now that we know what we're talking about, let's look at the first side of this debate, the case for a recession. Why are so many economists sounding the alarm bells and saying these tariffs are a huge threat?
And really, you can't get a clearer warning sign than this quote from the financial giant Goldman Sachs. They're not just saying it's a minor problem. They're saying it's the single biggest risk to the U.S. economy right now. That's a powerful statement.
And you can actually see the immediate effects in the data right here. PCE inflation, that's a key number the Federal Reserve watches closely. It jumped from around 2% in April to 3% just 2 months later. For everyday people, that means the cost of goods went up, almost overnight. That's a direct hit to your wallet.
But what about the long run? Well, according to that same Penn-Wharton budget model, the picture gets pretty serious. They project that by 2054, the entire U.S. economy, the GDP, could be over 6% smaller than it would have been. And for you and me, that means wages could fall by almost 6%. That's a major hit to our buying power for decades to come.
And if you want one number that will really make you sit up and pay attention, here it is. The investment bank UBS ran their economic models and, wow, they came up with a 93% probability of a U.S. recession. Now, not every forecast is quite that high, but a number like that shows you just how seriously some of the world's top analysts are taking this risk.
Okay, but that's just one side of the coin, right? Let's flip it over and look at the case against a recession. The supporters of these tariffs argue that, yeah, they might be disruptive, but they could actually make the U.S. economy stronger in the long run.
So, remember that absolutely huge $5.2 trillion figure we mentioned? Well, here's where the proponents of the tariffs get really excited. According to the Penn-Wharton budget model again, that money could be used to slash the federal debt by almost 12% by the year 2054. The argument is that a country with less debt is a healthier country, which could spark more private investment and growth.
So, with all these warnings, you'd think the stock market would be tanking, right? Well, not exactly. As of August, the tech-heavy NASDAQ 100 was actually up over 10% for the year. Proponents point to this and say, see, the markets aren't panicking. The most innovative parts of our economy are still booming.
The Penn-Wharton budget model gives us a really interesting comparison here. It's like, okay, if you need to raise a ton of money, you have options. You could use tariffs, or you could hike corporate taxes. Now, their model shows that tariffs do have a bigger negative hit on GDP, but proponents argue that hit is manageable and it's a better choice than directly taxing American companies.
So, we've talked about the U.S. economy, but these tariffs don't happen in a vacuum. They are sending massive shockwaves around the world, enforcing a complete reset of America's trade relationships, moving from big, broad agreements to intense, one-on-one deals.
Take the European Union, for example. This is a classic case of using tariffs as a bargaining chip. The US hit most EU goods with a 15% tariff, but in return, they got the EU to commit to a whopping $600 billion in US investments and another $750 billion in US energy buys. It's a high-stakes negotiation.
Now, the story with China, it's a completely different beast. This isn't negotiation, it's an all-out trade war. U.S. tariffs on some Chinese goods have soared to an incredible 145%, and China is hitting back hard with 125% tariffs. The tension, especially over things like technology and rare earth minerals, is just off the charts.
And then there's India, where things got complicated fast. The U.S. slapped a 50% tariff on them because India was still buying Russian oil. This put over $36 billion of Indian exports in jeopardy and basically froze all trade talks. It's a perfect example of how these economic policies are spilling over into global diplomacy.
But then you have Japan, which is being held up as the big success story of this whole strategy. Japan is facing that 15% tariff, but in exchange, they've locked in $550 billion in investments into the U.S. and also promised to buy $8 billion of American farm goods every single year.
All right, we've heard the arguments for, the arguments against. We've seen the global chaos. So, what's the bottom line? Where does all of this actually leave us?
Honestly, this one chart pretty much says it all. Just look at this incredible range. On one end, you have UBS saying there's a 93% chance of recession. But then Oxford Economics says it's only 35%, and Goldman Sachs puts it even lower at 30%. When the experts disagree this much, it tells you the one thing they all agree on. Nobody is really sure what's going to happen next.
So, let's just quickly recap the key takeaways here. Yes, there is a very real risk of recession, but it's not a sure thing. On the flip side, there's the potential for huge revenue and a big cut in the national debt. And globally, U.S. trade policy has been completely rewritten into a game of high-stakes, one-on-one deals. The only real consensus is that we're in a period of massive economic uncertainty.
And that brings us back to the multi-trillion-dollar question. Are these tariffs forging a stronger, more resilient domestic economy, or are they the trigger for the next global downturn? Only time will tell. If you found this explainer valuable, please like this video and subscribe to the channel. Thanks for joining us.